Hello and welcome to Short Briefings on Long-Term Thinking. Thanks for joining us. I'm Malcolm Borthwick, Managing Editor of Intellectual Capital at Baillie Gifford. These are turbulent times for investors. During the past few weeks, we've seen dramatic falls in global stock markets, even by historic standards. Baillie Gifford was founded in 1908. It has survived the Great Depression, 2 world wars, and numerous stock market crashes. So what has more than a century of investing taught us about how to navigate crises like this? I'm joined by Scott Nisbet, who's a partner at Baillie Gifford. But before we start, some important information. Please remember that as with all investments, your capital is at risk. Scott, you joined Baillie Gifford in 1996. How does this crisis compare to others?
Well, as you alluded to, Malcolm, we'd been through a lot of crises before I joined in 1996. But even since then, you start looking back and you think, 1998 was the Asian and Russian debt crisis and long-term capital management. 2001, it was the tech bubble bursting, though, hindsight might say that maybe that's not the most accurate description of it. 2008, the global financial crisis. Now we're in this. There have been other things in between, like SARS. You start thinking, wow, there have been a lot of crises, and yet over the last 25 years, the value of equities has gone up. So I would say that each one is different in at least 3 different ways. But the first 2 ways, the first 2 levels of difference people never talk about, and the third level of difference is the crisis itself, and people talk about that. But there's 2 levels before you even get there that tend to be ignored.
And what are those different levels?
Well, the first level is a personal one. I mean, in 1998, I was a third-year investment analyst at Baillie Gifford. I had no idea what was going on. I mean, I knew that the stocks that I'd written on and recommended were going down in price, but I didn't really get what was going on. And I think that's quite an important point because, nowadays, I guess I'm one of the quite senior people at Baillie Gifford, but there are a lot of people in everybody's firms who haven't been there before. So you need to bear in mind that personally, people are at different stages in their career. They have different levels of experience, and therefore they will be experiencing the crisis differently each time. So that the first level is the personal level. The second one is the firm level. Baillie Gifford is not the same firm as it was in 1998 or 2008.
And how do you help people on a personal level who maybe haven't been through a crisis before?
As I was alluding to with the firm, there's certain constants with Baillie Gifford. So we remain an unlimited liability partnership. So we're very aligned with our clients' interests. We remain a place that really tries to take a long-term view and one that tries to really look after our younger staff. But where it changes, the culture changes a bit in a crisis, and I saw this in 2008 and I'm seeing it right now, is that generally speaking in the investment teams, for example, we let people follow their passions. I mean, our investment philosophy is if you can find a few absolute home runs that shoot the lights out, then that's what's going to make your portfolio return over the long run. And the best way of people doing that is by following things that they're very interested in. So we tend to have really quite, by some standards, quite unstructured approach. People just go and look at companies they're interested in, and this idea of coverage, how are you covering the market, is very outdated. But when it comes to a crisis, we have to change the culture a bit because you need to give a bit more direction. Not only do you need to show leadership, but you need to just give people jobs to do. One of the things we noticed in 2008, a bit at Baillie Gifford, certainly with our clients and certainly with some of our competitors, is people actually stop doing their job. Everybody's going around saying they're really stressed and what do you think about the markets? And what are you actually doing? And so at times like these, I think it's very helpful to give a bit more direction than we normally would. And in 2008, there was something that we did, which was a very useful exercise, and we're doing it again now, and that is looking at the balance sheets of the companies that we invest in. Usually we're spending a lot of time saying, look how much this company could grow over the next 10 years. It's worth 5 or 10 times the amount it is today, which is great, and that we'll come back to that. But it has to be around in the first place in order to grow. And therefore, right now, a number of our analysts are spending some time looking at the balance sheets of our companies, as they did in 2008, to say, right, let's just check that this is going to survive.
But this is very difficult, though, from a behavioural analysis perspective. People are naturally trained to knee-jerk responses, or maybe to trade on the negative as opposed to look for the positives. How do you guard against that?
First of all, it's difficult even normally, but it's extremely difficult now. So we say things like, oh, don't read too much of the news, and go and find different sources, such as academia. And I think we've done a pretty good job of that. But if you look at behavioural studies, then and the power of bad, and you look at work by people like Kahneman and Tversky, a ratio of about 4-to-1 comes out. That you hear 4 times more negative news than you hear good news, or you have a 4 times stronger reaction to something going down than joy at something going up. So to have a chance, you have to consciously combat that. You have to aim off for that. So in our stock discussions, I think one thing that separates us from many managers is that we spend most of the time looking at the upside. How well could this company do? Now, we do need to check it's going to survive first, but then how well could it do, and how undervalued is it? Whereas I think most people's tendency is to spend most of the time knocking the case down and saying, but what about this? But what about that? And so, for example, we have a rule in the team I work in that the first 20 minutes we discuss a stock, you are not allowed to say, if you're going to speak, you have to say something that contributes to the bull case. If you say, but, what about, you get kicked out of the room. Now, even after having this, protocol for many years, you'd be surprised how often people still get kicked out of the room, because it's our natural tendency to be negative. So I think you need to put conscious, almost formal things in place to combat what is a natural instinct to be negative, and one that is compounded for sure at the moment.
I mean, having perspective and staying calm is vital in these situations. How do you personally stay calm?
On a personal level, I think there's 2 things. One is that you need to get away from it all. So playing a sport, for me, it's tennis, but it could be basketball, it could be playing the guitar. I don't know what it would be for something, but it's something that you have to concentrate on the immediate thing in front of you right now, otherwise you're going to muck it up, and you're forced to put everything else out your mind. And the other way would be literature. As you probably know, people at Baillie Gifford come from all sorts of disciplines. We're quite unusual in that way. Typically in a financial services firm, you'll have a lot of economics or graduates or accountants or a lot of CFAs, and we tend to have a lot more people from arts backgrounds. So reading is great, and when there's a bit of a crisis, I always think, well, what's the great novel or the wonderful book that I've read that is most akin to what we're living through now, and what can I take from that? And for this kind of crisis right now, there's a really obvious one that I just put on my bedside table again last night, and I started rereading.
And what's that?
Oh, it's the Plague by Albert Camus. Now he wrote that in 1947. Well, he actually wrote it during the Second World War. Published it in 1947, won the Nobel Prize for it. But it's the story of the bubonic plague coming and terrorising this small town in Algeria. And the story is about the heroics that you see, and also some of the bad side you see from human nature, the cowardliness, the selfishness. And what Camus concludes at the end of the Plague, and we really recommend people to read it, of course, is that the crisis showed that there was more to admire in human beings than there was to despise. And he says at the end, future plagues will come and test future peoples, but the conclusion will remain the same. There is more to admire. And so as I'm kind of quietly going around, sending out crisis comms and checking people, still doing their work and stuff at Baillie Gifford, every interaction, I'm slotting it into Camus' very simple moral existential framework for how do people behave in this crisis. And, I'm happy to report that I think that the good guys are well ahead at the moment. So I think, human beings are very inventive and very innovative, particularly when there's a time of stress. That's when you see innovation come through. That's when habits change. And I actually think that we're very well positioned to deal with this now than that compared to any point in our history.
That innovation also happens in companies, doesn't it?
Yeah, I mean, the first level is are we keeping our business going, which is fine, and are we looking after our staff, and are our clients okay, and let's keep them calm and say, yeah, of course, if you need money back, we can give you that kind of stuff. And then you go into the portfolio, and you look at some of the companies we've bought recently. We don't want to sound triumphalist about it. We don't want this to be happening, but if this is going to happen, the fact that we own a lot of shares in Zoom. I mean, how many people are? The use of Zoom must be absolutely exploding worldwide right now. We bought a lot of shares in Peloton. Now, how many people are going to be doing their exercise bike stuff from home who were going to David Lloyd or Virgin Active or wherever, and they're all shutting? You look at Amazon. I mean, we already saw a huge move online in the last 10, 15 years. But some of the companies we own, like Amazon or Netflix or Alibaba, they're going to get a further shunt in their direction. There's a further secular move because not only do people change the way they interact and behave now, but when things return to normal, in inverted commas, it's not the same normal as before. So I think in terms of our portfolios, you could make a very strong case for, look, once this horrendous period is over, we have portfolios that are very well positioned in terms of the kind of companies they own to benefit from even more growth in the future. It just feels like you don't want to sound too arrogant about that right now, because there's a lot of kind of economic cataclysm for a lot of ordinary people to get through first.
And from an investment perspective, there'll be successes as well as failures. You deal very closely with a lot of our clients, Scott. Typically, what type of questions are they asking you?
Well, the first question they've been asking us is, are you okay? I mean, one of the things with Baillie Gifford is that, our average duration of a client is about 15 years. Now, that means they're not just a client. You know these people. You've met them many of times. You've been through ups and downs with them. So actually the first one is kind of a are you all right question. The second one is, are you able to continue, doing the basics of your business? Pricing funds every day, trading if need be, if a client needs their money back, that kind of thing. And we've been able to reassure them on that. And then the third question, which they're just getting around to now, because obviously there's a couple of weeks of adjustment and a lot of our clients are working from home and it's not normal for them either, is the portfolio going to be okay? What's the most recent performance telling us? And obviously we usually avoid talking about very small periods of time performance. You can't really take any meaning from them. But because it's been so spectacular, clients are keen to try and derive some kind of conclusion for how's Baillie Gifford doing. And even in very short periods of time where the market's been going down quite steeply, as you alluded to, our kind of companies are holding up pretty well. I mean, they're going down in value, on the short-term basis, but not relative to the market. And most of them have very strong balance sheets, so most of them are going to survive. But coming back to your point about successes and failures, one of the things that we try and be very tolerant of at all times is things going wrong. Okay, if you're going to be brave and buy some companies that might go up many times, then you're also going to buy some companies that are going to disappear altogether. So the fact that some of our companies will disappear over the next 6 months isn't actually that different, to normal. We're used to that. We expect that. Arithmetically, it usually isn't that important for the return of the portfolio. What's important for the return of the portfolio is you have some of those home run winners. And as I said a couple of minutes ago, I think we have quite a number of them.
Scott, and what about liquidity?
That's a very good point. That does become very much to the fore for clients at a time like this. One thing we found in 2008 is people talk about 2008 as, equities fell 45% or whatever the number was. Equities continued to function. I mean, they worked. And we found that in 2008, a number of our clients used us as a bit of a giant ATM machine because they couldn't get their money back from anywhere else. And so in that sense, we would question how people think of risk, because the ultimate risk is that you can't get your money back. And people talk about equities as though that's a risky asset class. Well, if it is the asset class that remains liquid in times of crisis, then you need to rethink how you apply this word risk to equities. So a number of the questions we've had in the last couple of weeks have been, if we needed some cash back, can you raise the money? And the answer is, yeah, of course we can. We wouldn't advise you selling stocks at this level if you can avoid it, but actually, the function of doing it is no problem, and we've been delivering cash back to our clients in the last couple of days where they've needed it.
And just to clarify, this podcast will be going to both institutional and retail investors. That's more on the institutional side, isn't it?
Yeah, absolutely. I mean, obviously, if you're a retail investor, you're not trading in the volume that some of our clients are. So, I mean, if liquidity isn't an issue for our institutional clients, it's certainly not going to be for retail investors. But the point about staying calm, and I mean, unless the retail investor needs the money, I don't know, they have to pay for their house next week, otherwise it doesn't go through and they need them. Unless there's something like that, then, I really don't think it's a good idea to be selling at this stage. Even if you wait 2 years, I know that's 2 years sounds like a long time now, you'll probably think, wow, I'm so glad I didn't panic.
Scott, thanks very much for joining me, and I hope you'll join me again soon on the podcast.
You're welcome. Thanks.
You can find our podcast, Short Briefings on Long-Term Thinking, at baileygifford.com/podcasts. And you can subscribe at Apple Podcasts, Spotify and TuneIn. If you enjoyed the podcast, please spread the word. And if you'd like to find out more about Baillie Gifford, our culture and how we approach investing, check out baileygifford.com/about-us. And many thanks to Lord of the Isles for the music. The track we've used is called Horizon Effect, which was released on permanent vacation. Until next time.